Hi, everybody, and welcome to Chapter 4, Accounting for Merchandising Operations. And here, we're going to take a look at how merchandising activity are accounted for. As usual, at the end of the chapter, there's analytical techniques, and that's our acid test or quick ratio, and the gross profit margin ratio. We're going to look at some fairly sophisticated concepts using perpetual inventory system and then our periodic inventory system. And lastly, we will take a look here at the multi-step and single-step income statements and record the transactions under both the periodic and the perpetual inventory system. And I think you're going to like this. I will let you use, as part of your notes for the exam, Appendix 4A, so that that becomes a little more easily understood. I think there's a lot in that, and I don't want you to just have to rote memorize it. Okay, and lastly, we'll briefly go over these new revenue recognition rules. I don't put a lot of emphasis on that in this course, but I do want you to know how to do it. Okay, and then lastly, we'll take a look at the gross method and the net method. Pretty easy, I think. Okay, in our first learning objective, we're going to take a look at those merchandising activities and cost flows. And here, our service companies, the big distinguishing difference in that is that we don't have any inventories. If you deal with a law firm or even plumbing services, accounting firms, those kinds of businesses, they sell their services. They don't sell products. So in this case, they're not going to have any inventories. When we go to the merchandising companies, they have one kind of inventory, and that's merchandising inventory. So that's the products that they buy from manufacturers and they put on their shelves, and then we go in as patrons and customers and purchase those. Okay, so the merchandiser is going to have net sales, and we'll talk about the difference between net sales and gross sales here in a few minutes. Then we have our cost of goods sold. These are all income statement accounts now. And then we subtract cost of goods sold from net sales to get to gross profit. And then we subtract expenses, operating and non-operating expenses, and eventually we have our net income, which is how much money we hold on to. Some of those expenses, of course, might include tax expense. Okay, so the operating cycle for this merchandiser looks like this. They start with cash, or I should say they start with the purchase, and they bring it, these, in this case, bicycles, into their merchandise inventory. They generally make credit sales. Credit sales meaning they're going to debit accounts receivable and credit sales for that. And then eventually those customers will pay and will debit cash and credit accounts receivable to finish the transaction. So important to know that operating cycle. Nice little graphic here from the standpoint of here's our net purchases, net meaning after purchase returns and allowances, and our beginning inventory. And if we add those two together, we get the merchandise that we can sell. One of two things happens. We either keep it. If we keep it, it stays in ending inventory. If we sell it, it goes out the door, and that's our cost of goods sold. So this is the cost side of inventory transactions. All right. we have two kinds of inventory systems. The first one's a perpetual inventory system, and that updates the accounting records each time a purchase or sale is made. If you go into IKEA, for example, you go and you say, oh, there, you look on their little kiosk and you hit the computer and up comes that little black desk that you want. You walk over to the inventory location B54 or something like that, and there are 4 of them, just like the kiosk said. You take one and put it in your cart, and out the door you go. After selling it, the system automatically decrements that inventory down to 3 units, and IKEA knows right away how much inventory it has. Periodic systems are different. They update the purchases and sales of inventory only at the end of the period. So big difference there. And we'll get into that a little bit more in this PowerPoint. Okay, now we're going to analyze and look at the transactions under a perpetual system. So now, if we purchase something and put it into we're IKEA, and we put that into our merchandise inventory, we're going to debit inventory. Inventory is an asset. We debit it to make it get bigger, and we pay cash for it, let's say. Sometimes that's accounts payable, but in this case, they're paying for it with cash. So they purchase these goods, and it goes into inventory. Now, sometimes a seller can grant a cash discount to encourage the buyer to pay earlier. This is called a cash discount. All right, so what this is going to say is I have a total credit period and a discount period, and we'll see how that works here. There is some abbreviations here that you really need to know. And this is pronounced 210 net 30. Okay, so 2 represents the discount percent. And if you pay within 10 days, you get to reduce your purchase by 2%. But if you don't pay within 10 days, you have to pay within 30 days. That's the net is due within 30 days, and you don't get the 2% discount. See how that works? Pretty simple, really. Called a purchase discount. So here's our invoice. We're invoicing Z-Mart because we sold this to Z-Mart. We are TRC. So TRC sells to Z-Mart. The purchasing agent was Tom Novak, and they're in a variety of places. But the key thing is that our terms are 210 net 30. And FOB, we'll talk about that later in this PowerPoint, but that stands for free on board, and which makes little sense, frankly. But nevertheless, FOB tells you when the goods transfer title. So a very important determination. So we're not going to transfer title until these goods get to the customer, Z-Mart in this case. Okay, and they're shipping via FedEx, and here's the stuff that they're purchasing, some clothes it looks like, and it totals $500. Now, if you pay within that 10-day period, you can take $10 off of that $500 total. Okay, here is a purchase with cash discounts using the gross method, and the gross method is what I'm used to. It's by far the more popular way to do things. So here they're purchasing $500 of merchandise on account. Okay, so, and the credit terms are 210 net 30. So when we purchase initially, we're going to debit the inventory to increase it, credit accounts payable, the liability, to increase it. And we're increasing it by $500. We haven't considered the credit terms yet. Okay? We have not yet. But once we do, now they pay this amount within that 10-day period. So they're going to take the discounts. And so they reduce the entire accounts payable with a debit that washes out that credit that we just posted in the previous transaction here. So when we debit it, it washes that liability out. We're going to pay cash of $490. What do we do with that $10? That discount? We reduce our inventory. We reduce the inventory. It's not a separate account called discounts or something like that. We are showing our inventory that way at what we paid for it. Very important concept here. So don't get confused on that. When we pay this within the discount period, that discount, that $10 in this example, we reduce our merchandise inventory with a credit of $10. Okay. So how does that little beauty look in T accounts? Here's our accounts payable. Very simple. Initially we credited it. Initially we credited, and then we debited, and a balance is zero. Merchandise inventory, we started out with the $500 in the original journal entries, but then we reduced it by $10. So the balance in merchandise inventory represents what we paid for it, and what we paid for it was $490 in cash. Okay, now if we purchase after the discount period, that makes it very easy, right? We just debit accounts payable to make it go away and wash it out, and credit cash for $500, and we don't get to reduce our inventory by $10. So that's how we make a payment after the discount period. All right, we have purchase returns and allowances. What are those little beauties? Well, a purchase allowance is a price reduction to the buyer because of defective or unacceptable merchandise. I always use the example of going down to Nordstrom's and buying a Christmas sweater. And if I buy a nice pretty wool Christmas sweater that's bright red, something like that, I get it home and I find out the moths have eaten a hole in it. Not a good thing. So I take it back to Nordstrom, and I can say, hey, I'm going to return this because it's a bad product, and I can just return it, or maybe got a nice new unholed sweater. Or I could say, hey, my grandmother is a great seamstress. She used to be anyway. And I think she can fix this thing, but I want a price reduction. Instead of the $700 I paid for that sweater, I want it for $500 or a $200 discount. And so it's an alpaca sweater. It was a nice one, right? So, and Nordstrom says, a hole in that sweater is going to be pretty hard to sell. So, okay, I'll agree to that. And away I go with a price reduction, a purchase allowance. So two kinds of reductions here. So if I get a purchase allowance, then this for a $30 allowance from Trek for this defective merchandise, very simply, I'm just going to reduce my accounts payable with a debit and reduce my inventory or by that same amount. So that's how we would do that journal entry. That looks like a good place for us to stop this video. And when we return, we will take a look at purchase returns. Until then, bye for now.